Here's something that might shock you. Two retirees can have the exact same investment returns over 20 years, and one could end up broke while the other is living comfortably. And the difference? Pure timing. We've seen similar scenarios play out many times. It's called the timing trap, and it's the retirement nightmare that many couples overlook. There are 3 straightforward strategies that could help protect you from this timing nightmare. And the best part, they're actually simpler than what most people try to do. And these aren't experimental strategies. They're time-tested approaches we've used to help hundreds of couples navigate market volatility and retire with confidence. The examples I share today use adjusted details to protect our clients' privacy, but every situation is based on real patterns from our practice. And by the end of this video, you'll have 3 specific strategies that you can implement right away. Let me paint you a picture. 2 hypothetical couples both retire with $1 million portfolios. Couple A retires in January 2008, right before the crash. Couple B retires in 2012, right as the recovery is happening. Over the next 10 years, both portfolios average the exact same 7% annual return. But here's what happened. Couple A might be close to running out of money, while couple B could be planning their next vacation. Same returns, completely different outcomes. This is the timing trap. It's not about if the market goes up or down, it's about when those ups and downs happen, especially in your early retirement years. When you're withdrawing money from your portfolio, timing can matter just as much as the average return. Get hit with those losses early and you might never recover. Remember, we're trying to address the timing trap, how identical returns can potentially create different outcomes based on when you retire. So how do you protect yourself from being couple A? Most people think the solution is to get better returns or pick better investments. But the first protection actually has nothing to do with your investment choices. Therefore, the first strategy focuses on something many people get wrong from day one: how much you take out. Here's what can happen when you retire right into a market crash. If you're taking big withdrawals from a portfolio that just got hammered, you may be locking in those losses permanently. But if you start conservatively, you can give yourself breathing room for the market to recover. That's why we often suggest considering a withdrawal rate of around 4%. It may feel like playing it safe, but it could be buying you time. Time for the market to potentially recover and avoid locking in these potential losses when you can least afford it. You're learning the same approach our clients often use to help avoid becoming couple A. But without this next piece, even a smart withdrawal rate may not protect you when markets turn volatile. Starting conservatively helps, but what happens when markets recover and you're still being overly cautious? You could miss out on enjoying the good years. Therefore, the smartest retirees don't stick to the same withdrawal amount every single year. They use what we call guardrails. We worked with a client who did a strategy just like this. Imagine an example couple planning their dream European anniversary trip in 2008. When the market crashed, they had a choice: cancel the trip or sell investments at a huge loss to fund it. Instead, they did something even smarter. They delayed the trip 1 year. By 2010, the portfolio had recovered and they took that vacation without compromising their long-term security. This is an example of what we call using guardrails. Just like guardrails on highway keep you safe when conditions get dangerous, spending guardrails protect your retirement when markets get bumpy. You might set a base withdrawal target, but if your portfolio drops below a certain level, you could temporarily scale back. If it grows above a certain level, you might give yourself a raise. This approach can help you navigate the timing trap that may catch many retirees completely off guard. Here's the thing: conservative withdrawals and guardrails can help protect you, but they both still assume you're pulling money from the same pot where the markets are up or down, which means you might be forced to sell investments at a difficult time just to pay your bills. That can be dangerous. Therefore, the third strategy isn't just about diversification, It's about strategic diversification that gives you options when timing is working against you. Imagine you retire and the market drops 25% in your first year. If you're all in stocks, you may be forced to sell at the worst possible time just to pay your bills. But if you have cash and bonds set aside, you can let those beaten down stocks recover while you live off the safer money. Think about it. Many people just spread money around, but strategic diversification for retirement may mean having the right money available at the right time. So market crashes might become more manageable instead of disasters. This isn't just about stocks and bonds. It's about having a mix of assets that may respond differently in different environments. Stocks for growth, bonds and cash for stability. In diversification, it can help smooth out the ride. And when you're retired, a smoother ride may mean a longer lasting portfolio. Now I'm curious, what's one retirement risk that keeps you up at night? Is it market timing, taxes, or something else entirely? Let me know what risk you think about the most. Let's recap what we covered today. The timing trap is real, and it may make the difference between a comfortable retirement and running out of money. And the 3 strategies to protect yourself. First, start with a conservative withdrawal rate. Second, be flexible with your withdrawals based on market conditions using guardrails. And third, diversify your investments for both growth and stability. If this helped clarify something you've been wondering about, we share insights like this regularly. After helping hundreds of couples through retirement planning, we've learned there are quite a few risks that aren't talked about enough. And if you'd like to see more videos like this one, feel free to subscribe. We'd love to have you along for the conversation. Take care, and I'll see you in the next video.